over a month ago, before President Trump's trade war really kicked into gear, I wanted to get a sense of what happened to the stock market during his first-term trade wars, because I thought it could help us figure out the current moment. That's why we went off the charts with Jessica Inskip, the first woman on the active trader desk at Fidelity, who's now director of investor research at stockbrokers.com, as well as co-host and founder of her Market Make Her podcast. Her take was nuanced. When she looked at the trade war that kicked off with China in January 2018, the market initially got hammered. But within a few months, it bottomed, and over the next couple of years, well, stocks gradually worked their way higher again. Short term, though, the pain was brutal, and Inskip made some dire projections from where the major averages might be headed. In fact, every key support level she mentioned has now become a new ceiling of resistance. Why don't we take a look at it now? Because I got to tell you, I think it's pretty intense. It's the only way I can describe it. Take them one by one. Started with the weekly chart of the S&P 500. Okay, right here. Inskip points out that this is a textbook ugly chart, all right? The S&P has made a series of lower lows and lower highs, creating a new downtrend line. At the same time, she says it's now has a bearish trading cycle. Remember, Inskip likes to watch the 13-week, the 26-week, and the 40-week moving averages, because 13 weeks equals 1 quarter, and quarters are the basic unit measure of business. Right now, all three of these key moving averages are sloping downward. And they're all hundreds of points above where the index is currently trading, meaning they become ceilings of resistance here. See, look at that. Big, big gap. That makes it much harder for the S&P to rally. The first ceiling is the 13-week moving average, right? And that kicks in at 57.47, and that's up about 350 points from here. Before that's even in the realm of possibility, though, Inskip says the S&P needs to break out above its lower low from the week of March 10th, which is 5504. And that might be a tall order, too, because the S&P's got very little mojo at the moment. You saw that all day today. As Inskip sees it, all major defensive lines have been breached, and they've now become barriers in the way of higher prices. In fact, the 13-week moving average is now below the longer-term 40-week moving average. That's a very bad sign for chart watchers. It suggests that we're looking at more downward pressure going forward. Now, when we consulted with Inskip a month ago, she told us that the S&P might be able to make a reversal once the stock started getting much closer to the lower Bollinger Bands. Bollinger Bands reflect the level of volatility. They're the purple lines here, okay? Well, sure enough, when the S&P got below the lower band, it bottomed. Inskip doesn't think that's a coincidence. The White House put through the 90-day pause on most tariffs, at least in part because they could see the carnage in the markets, and they wanted it to stop. Of course, if you want a more holistic view of the stock market, the regular S&P 500 really doesn't tell the full story because it's known as being market capital, weighted by market capitalization. It means it's very dependent on a couple of mega cap tech stocks, even after they've gone down a lot, and they've been awful performers of late, although they rebounded nicely in the past week. To get a clearer view of the rest of the market, Inskip likes to look at the S&P equal weight, where every stock in the S&P has the same exact impact on the index. Check out the weekly chart. Obviously, the S&P equal weight hasn't been doing that great either. But Inskip notes that it found a nice floor of support at the 200-week moving average. Now, that's another one, 200-week. That's a long time. This is a level where the S&P equal weight has bottomed many times in the past. It happened in October of 2023. You can see we have these longer-term timeframes. In October of 2022, both of which were major turning points in the market. So it happened again last week. I like that. However, the S&P equal weight also closed below 6691. On Friday, which is where the index peaked in January of 2022, right before the Fed started raising rates. Oh, man, even after this week's rebound, it's still a bit below that level, basically wiping out 3 years of gains. Inskip says that the S&P equal weight needs to get back above that level as soon as possible. Because as long as it lingers down here, it's going to paint an ugly picture. That I thought was new for me, that it mattered how much time it spent. Because I say that because today the market did absolutely nothing. And that is part and parcel with, unfortunately, the bad sign that she's giving us. Finally, how about tech, which led us higher for so long, then led us much lower starting in February and getting much worse after the trade war kicked in? All right, Inskip likes to watch the Technology Select Spider Fund, and that's known as the XLK. Okay. Everyone calls it that, and it's talked about a lot in the business. And even though it's been bouncing over the past week, it ain't pretty. See the pattern here? Like the others, the XLK has fallen below its 13-week, 26-week, and 40-week moving average, all of which are tilting lower. For her, that means we have a bearish trading cycle on our hands. For Inskip, the key here is that the tech ETF has found its floor of support at its 200-week moving average, just like the last one, okay? That's currently around 172. Down roughly 30 points from where the XLK is now trading. Pretty much exactly where it bottomed intraday last week. When we talked to Inskip a month ago, she said that that's where she'd be willing to start buying on weakness, and that was a good call. For now, the XLK stands at about 201, and Inskip points out that it's facing a ceiling resistance at 205, which represents the trend high from March of last year, the higher low last May, and the gap up last August. This is another tested and tried level. A month ago, Inskip said it would be a nightmare if the XLK broke down below 205. Well, she was very, very right. Here's the bottom line. A little over a month ago, we checked in with Jessica Inskip, who warned us that the major averages could go much lower if they breach key support levels. While we didn't have much detail on President Trump's tariff plans, you don't need that kind of detail to read a chart. And that's the great thing, actually, about technical analysis. Now, the charts interpreted by Inskip show that the S&P 500, the S&P equal weight, and the XLK Tech Fund are all being propped up by the 200-week moving average. None of these is pretty, but for the moment, the downside looks contained. Let's go to Merrill in Washington, D.C. Merrill.
Good evening, Jim, and thanks for taking my call.
Of course.
I do believe that one should do their homework before buying a stock. And in that vein, I'm very happy that you do a lot of homework for me.
Well, thank you. Thank you very much. I sure try. I like homework.
You do a great job,
it.
Jim. You really do.
Thank you.
Now, that said, I think I know quite a bit about machine learning. But my question is, I believe in Salesforce as a great company and that their sales team should be able to sell sales agent. But apparently, they've not been able to do that in a meaningful way. Is that the reason their stock has materially gone down in the last 6 months?
100% right. They've got the best product, of which there is no doubt. Had they been able to monetize the best product? Not to date. Is the stock indicating that they won't do it this quarter either? Yes. But the good news is we have until the end of May. Maybe it can turn things around. But this stock, as I said to Jeff Marks today, my partner for the Chapel Trust, this stock just acts so badly. And the enterprise software companies were beginning to act better, and this one's not one of them. Only up 38 cents today. We've got to stay very close to this. Let's go to Mike in Louisiana. Mike.
Hey, Jim.
Hey, Mike. How you doing?
Oh, I'm doing pretty good. We got a beautiful day down here in Louisiana.
Oh, good for you. I love that. I love Louisiana. My daughter went to school at Tulane. Love it down there.
Oh, good deal. What you think about Micron right now?
Micron is at 10 times earnings. I really wanted it at 6, 7 times earnings. That said, Micron is a one-way stock. It has a great year and then a bad year. The stock has been more than cut in half. I'm willing to venture that more than cut in half, you can put a quarter position on. No more than that. And then wait for it to drop back down. It's at 71. It traded 61. I would buy another quarter if it traded 61 and then wait and see. But it is not an up stock as much as I like it. All right. The charts, as interpreted by Inskip, show that the S&P 500, the S&P equal weight, and the XLK Tech Fund are all being propped up by their 200-week moving averages. The downside here looks contained, at least for now. Now, much more mad money ahead, including my deep dive on 2 consumer names that I think have a path for growth and even market share. Then, as interest rates fell today, I'm giving you my take on the tape's reaction. And, of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.